Alright, now on to the most important screencast of the unit and where we've been leading to this entire time, monetary policy. Here's what we know. When banks loan out their excess reserves, they create new money, and that money turns into a lot more money through the whole multiplier process. Now, the Federal Reserve uses this process to change the money supply in the economy, and it does it using three tools, and this is important. You need to know these three tools and how the Federal Reserve uses them to change the money supply. The three tools the Fed could use to change the money supply are called the discount rate, the reserve ratio, and open market operations. Let's talk about each one in turn. Let's start with the discount rate, and as we do so, I'm going to keep up that T account that we saw a couple of screencasts ago. Keep track of what's going on in a particular bank. First off, definition. The discount rate is the name of an interest rate. It's the interest rate that the Federal Reserve charges to banks when banks borrow money from the Federal Reserve. Oftentimes, the banks will borrow money from the Federal Reserve at a relatively low interest rate and lend it out at a higher interest rate, which is one of the ways that banks make money. Now note, this is different than the federal funds rate that I talked about last time. The federal funds rate is the interest rate that banks charge one another. The discount rate is the interest rate that the Federal Reserve charges to banks. Now the idea is that when banks borrow money from the Federal Reserve, it increases their excess reserves, which means they can lend out more money, which means they can create more money. So again, let me just take you to that last slide and follow the excess reserves. Let's say a bank has excess reserves of $45,000, but then borrows $10,000 from the Federal Reserve, paying an interest rate called the discount rate. If it borrows that $10,000, it's going to have $10,000 more in excess reserves, which is $10,000 more it can lend out, and that money can get multiplied and turned into even more money. Now the second tool is the reserve requirement, and we've already seen what the reserve requirement is. By changing the reserve requirement, the Federal Reserve can change the amount of excess reserves, which again changes banks' lending potential. So again, looking at the balance sheet where it started out, let's say that excess reserves are $45,000. Remember, that was from a reserve ratio of 10%. If the Federal Reserve were to change the reserve ratio to only 5%, then from that initial $50,000 deposit, they would have to keep less in the vault and they'd be able to loan out a little bit more. 5% of $50,000 would only be $2,500, which would mean that they'd have more excess reserves and again, more potential to lend out money and create money in the economy. Now the third tool is called open market operations. The definition of that is the Federal Reserve buying and selling government securities, typically bonds, in order to change the money supply. This is the most important of the three tools because this is the one the Fed uses the most. Let's take the situation of the Federal Reserve buying securities from either banks or people. Essentially what happens is that this is one way for the Federal Reserve to get money out there into the economy. What happens is that people or banks hand over these things called bonds that are not money, so they're giving up something that's not money. In exchange, the Federal Reserve pays them for these things, which is money. And now these people and banks have extra money that they can redeposit into other banks, and that money can get lent out, creating even more money. Essentially, it's a roundabout way, a tricky way for the Fed to get money into the economy. Just buy things from people. And one of the things that people have a lot of are bonds. So that's one of the ways that the Fed can get money into the economy. Conversely, when the Federal Reserve, sells government securities like bonds, it's acting like a vacuum cleaner of money in the economy. It's sucking money out of the economy. Because what happens is that people hand over money to buy these bonds from the Federal Reserve, so the Fed's taking the money out of the economy. In exchange, the Fed is handing over these things called bonds that aren't money, and now banks have less excess reserves, so they can make fewer loans, and we're going to see a decrease in the money supply. Now, in terms of the relative importance of each one, we're going to see that open market operations are by far the most important. The discount rate is used mostly as a signal by the Federal Reserve, and the reason for that is that it can change what the interest rate is, but it can't force banks to borrow that money. The reserve requirement would be a powerful tool, but it really messes with banks' lending potential and it messes with their profit expectations, and as a result of that, it's rarely changed by the Federal Reserve. Open market operations, on the other hand, are used all the time. In fact, they can be used every day. Every day, the Fed could be buying or selling government securities. It can be done in large or small amounts. They can buy $1's worth, they could sell $1 billion worth. And so they can calibrate what they need to do. And finally, they can reverse course really easily. They can buy government securities one day and sell them the next. So let's take a look at the two kinds of monetary policy, and these are going to mirror the kinds of fiscal policies that we've seen, either expansionary, trying to move AD to the right, or contractionary, trying to move AD to the left. Expansionary monetary policy would be used in the same instance that expansionary fiscal policy would be used, if the economy is in a recession, if aggregate demand is too low. It would be a combination of using those three tools in a specific way, lowering the discount rate, lowering the reserve requirement, or buying government bonds, government securities. Any of those things would increase the excess reserves of banks, allowing them to lend more money and increase the money supply. Tight or contractionary monetary policy would be exactly the opposite and would be used for the same reasons contractionary fiscal policy would be used, if aggregate demand is too high and if the economy is experiencing inflation. So the Fed could simply use those same three tools just in the opposite way, by raising the discount rate, raising the reserve requirement, or by selling government bonds or securities. Again, any of those things would reduce the excess reserves of banks and result in a smaller money supply. So what I'm going to take you through now is really the heart of this unit, the monetary policy cause and effect chain, how monetary policy works to change how the economy works. And this is the part of this screencast that you're going to want to really get down cold. So let's say the economy is in a recession, and let's say the Fed undertakes an easy money policy, an expansionary monetary policy, by doing one of the things we talked about, lowering the discount rate, lowering the reserve requirement, or buying government securities. Here's what's supposed to happen. First, all of those things will increase excess reserves for banks. Secondly, now that banks have excess reserves, or more of them, they'll be able to lend more money, which will increase the money supply. An increased money supply will result in lower interest rates. Lower interest rates will mean more investment spending and more consumption spending. As interest rates go down, people take out more loans and start spending more money. More spending means more aggregate demand. And more aggregate demand is going to mean higher GDP and higher levels of employment. So I'm going to take you through that same thing graphically, and these are graphs that you should be able to replicate, especially for the AP exam, very popular and really the heart of this unit. Alright, in the upper left-hand corner we have the money market graph that I introduced you to a few screencasts ago. In the upper right-hand corner, we have the investment demand curve that we've seen several times over the course of macroeconomics. And on the bottom, we have our aggregate demand, aggregate supply graph. Notice that aggregate demand is relatively low on the horizontal part of that graph, which means we're probably in a recession. So what the Federal Reserve does is use one of its three tools to increase the excess reserves that banks have. Banks make more loans. The money multiplier process turns that into even more money. And what happens in the upper left-hand graph is that supply of money shifts to the right, more money in the economy. As that supply of money shifts to the right, you'll notice that interest rates start to drop. Go over to the graph on the upper right-hand corner. As interest rates drop, let's say from 10 to 8%, the quantity of investment goes up. Likewise, the quantity of consumption spending, C, will go up as well. And as investment goes up, that raises aggregate demand, pushes it to the right, and that raises the level of GDP and employment in the economy. If the Federal Reserve were to do that again, lower the discount rate, lower the reserve requirement, or buy even more government bonds, we'd see more of the same. The supply of money would get pushed further to the right, interest rates would drop even further, we'd see even more investment spending, we'd see even more aggregate demand. These three graphs and how they relate to each other are very important and summarize how monetary policy works. Now, one final note on this screencast. The money market graph has this kind of generalized interest rate on the y-axis, the nominal interest rate. Now, in truth, there's lots of interest rates out there in the economy, and there are different interest rates for different things. They have names, like mortgage rates, interest rate you pay for loans to buy a house, the prime rate, the interest rate that banks charge to their most creditworthy borrowers, and the federal funds rate, the interest rates that banks charge to one another for very short-term loans. I mentioned the federal funds rate before. Well, when the Federal Reserve moves the money supply, they focus on one interest rate in particular, that federal funds rate. The federal funds rate, again, is the interest rate that banks charge one another for short-term loans. And what the Fed does is set a target for that rate, let's say 2%. And then what it does is tries to change the money supply by changing the excess reserves of banks accordingly to try to hit that particular interest rate. They think that'll lead to a certain amount of investment and a certain amount of moving of the aggregate demand curve. So the Fed focuses on the federal funds rate because it's the basis for a lot of other interest rates. A lot of interest rates are based on the federal funds rate. And as a result, it's particularly indicative of economic activity. Now, the federal funds rate isn't directly controlled by the Fed. They don't just pick a number and just turn a dial to that number. But by moving the money supply curve, they can try to hit what the interest rate, what they want that interest rate to be. All right. Again, this screencast is really the heart of monetary policy. It's what you need to understand the most comprehensively, and especially those cause and effect chain graphs that I just brought you through. If you have problems, come in and I'll help you out.
Damn it, this is too hard! Here's what I think of your test, Mr. Teacher!